Nearly every financial expert online will give you the exact same advice about Social Security. Hold off until age 70. Capture the 8% annual delay credit. Boost your monthly payment as much as possible. And under no circumstances, never claim at age 62 because doing so will cost you $246,000 in lifetime benefits. That is the standard wisdom. That is the sacred doctrine of retirement planning. And for a massive number of American retirees, that doctrine is mathematically and strategically incorrect. In this video, I am going to guide you through the 7 specific scenarios where claiming at age 62 is not a blunder, but the single most brilliant financial decision a retiree can make. And here's what sets this video apart from every other Social Security video on YouTube. Most of those videos are produced by financial advisors who earn fees to manage your retirement assets. They have a massive incentive to encourage you to postpone your Social Security check because the longer you delay, the longer they manage your other money. I do not manage your retirement assets. I work with retirees on the tax side, and what I observe every single week in my practice is the precise opposite of the standard wisdom. The retirees who postpone Social Security to 70 in the wrong scenario pay tens of thousands of dollars more in lifetime federal tax, get pushed into Medicare premium surcharges they did not anticipate, and miss the single largest Roth conversion window of their entire lives. The retirees who claim at 62 in the right scenario use the early check to fund tax strategies that lawfully save them $200,000 or more in lifetime tax. That is not hypothetical. That is what the math actually demonstrates when you run it for a real family. Reason number 1 is going to surprise you because almost no financial advisor will ever discuss it on YouTube. Reason number 2 is the scenario that catches retirees who got laid off in their early 60s. Reason number 3 is the family history reason every retiree should run the numbers on. Reason number 4 is for any married couple where one spouse earns significantly more than the other. Reason number 5 is for retirees with minor or disabled children still at home. Reason number 6 is for divorced retirees, and almost half of you watching this will qualify and not realize it. And reason number 7 is the reason every retiree under 65 needs to take seriously, because it relates to what occurs to Social Security in the year 2034. My name is Timothy. I am an enrolled agent federally licensed to represent taxpayers before the Internal Revenue Service, and I work every week with retired clients on the precise tax decisions surrounding when to claim Social Security. Before I dive into the 7 reasons, I have to share with you about a couple I worked with last year because their story is the perfect counterexample to the wait until 70 doctrine. And once you grasp what they did, you will see exactly why the standard wisdom is so often wrong. Robert and Joan are both 62 years old. Robert spent 34 years as a mechanical engineer at a manufacturing company in Indiana. Joan spent 28 years as a hospital administrator. They both retired at 62. They have a healthy traditional individual retirement account balance of $950,000 between them. They have no pension. They have a paid-off home worth $320,000. And when they came to me, they had been advised by 2 different financial advisors to wait until age 70 to claim Social Security. The reasoning both advisors offered was identical. If they waited until 70, their combined monthly Social Security benefit would jump from approximately $3,700 at age 62 to approximately $6,500 at age 70. Across a 30-year retirement, that delay credit would be worth more than $240,000 in additional lifetime benefits. Here is what neither of those advisors mentioned. From age 62 to age 73, when required minimum distributions begin under current law, Robert and Joan have an 11-year window where their taxable income is going to be the lowest it will ever be in their lives. They have no W-2 wages. They have no pension. They have only the small amount of Social Security they would claim for plus whatever they decide to withdraw from their traditional individual retirement account. If they postpone Social Security to 70 and live on individual retirement account withdrawals from 62 to 70, they will burn through $30 to $400,000 of retirement account principal during their lowest tax years. Then begin required minimum distributions at age 73 on a still sizable individual retirement account balance, which combined with full delayed Social Security at 70 will push them into a higher tax bracket for the rest of their lives. They will also trigger Medicare premium surcharges under the income-related monthly adjustment amount, known as IRMAA, that will cost them an extra $4 to $7,000 per year for the rest of their lives. The alternative I presented to them looked like this. Claim Social Security at age 62. Use the early checks to cover the bulk of their living expenses. Then, rather than pulling traditional individual retirement account money out as ordinary income, convert it to Roth individual retirement account dollars year by year, deliberately filling up the 12% federal tax bracket every single year from 62 to 73. Pay tax now at the lowest rate they will ever encounter on assets that would otherwise be taxed at 22% or 24% or higher when required minimum distributions began. Reduce the future required minimum distribution amount. Reduce the future tax exposure on Social Security. Reduce the future IRMAA hit and leave their family a Roth individual retirement account that grows tax-free for life and passes to heirs without a tax bump. When we calculated the math out to age 90, the claim at 62 plus Roth conversion plan saved Robert and Joan roughly $220,000 in lifetime federal tax versus the wait until 70 plan, even after factoring in the smaller monthly Social Security check. That $220,000 savings is greater than the supposed $240,000 gain from delaying. And that is before we factor in the fact that one of them might die in their 70s, which would close the Roth conversion window and turn the wait until 70 plan into a complete disaster for the surviving spouse. This is the story almost no Social Security YouTube video shares with you, because to share it, you have to grasp the federal tax code as well as the Social Security rules. So, with Robert and Joan in mind, let me guide you through the 7 specific reasons every retiree needs to consider claiming at 62. Reason number 1, the Roth conversion runway. This is the reason I lead with because it is the single largest tax planning opportunity most retirees in the country are overlooking right now. And it is the reason that gets ignored on every other Social Security video. The federal tax code rewards retirees who can keep their taxable income low for several years in a row. The years between when you stop working and when required minimum distributions begin at 73 are the lowest taxable income years of your entire life. If you can fund those years from a source that is mostly tax-free, you generate an enormous opportunity to convert traditional individual retirement account dollars to Roth dollars at the 12% federal bracket. Rather than paying 22% or higher when required minimum distributions, force the money out later. Claiming Social Security at 62 generates that low-tax source funding. You live on Social Security plus a modest amount of taxable individual retirement account distributions. You convert the rest of your traditional individual retirement account year by year. You drain the future tax bomb. You build a Roth account that grows tax-free for life and passes to your children tax-free as well. The math on this strategy for a couple with a traditional individual retirement account balance over $500,000 almost always saves more in lifetime federal tax than the delay credit gains in additional Social Security benefits. Almost always. And nobody talks about it because nobody outside the tax community realizes the runway window even exists. Reason number 2, you are already not working and burning down your retirement account. This is the scenario that catches a huge number of retirees who got laid off, downsized, or burned out in their early 60s. The standard advice is to live off your savings, draw from your retirement account, and postpone Social Security to 70. Mathematically, this almost always backfires. Every dollar you withdraw from a traditional individual retirement account between 62 and 70 comes out of taxable income at your full ordinary income tax rate. Every dollar you collect from Social Security between 62 and 70 is at most 85% taxable often, less depending on your other income. And Social Security is not subject to FICA payroll tax at all. If you are draining your individual retirement account anyway, you are paying tax on every withdrawal at full rates, and you are also losing the bird-in-hand benefit of having Social Security checks coming in alongside the withdrawals. The smarter approach in almost every case is to claim Social Security at 62. Reduce your individual retirement account drawdown by whatever amount the Social Security check covers, and let your retirement account continue to compound at market rates for as many years as possible. The compounding alone on the unspent portion of your retirement account often exceeds the lifetime delay credit on the Social Security check. Reason number 3, you have a family history of shorter longevity. This is the reason that even mainstream financial advisors will sometimes acknowledge but rarely run the actual numbers on. Social Security is at its core an annuity. The longer you live, the more total dollars you collect. The shorter you live, the fewer dollars you collect. The break-even point between claiming at 62 and claiming at 70 for someone born in 1960 or later is approximately age 80 to 82, depending on whether you adjust for cost of living increases and inflation. If you live past 82, the wait until 70 decision wins on total dollars collected. If you die before 80, the claim at 62 decision wins. And here's the part nobody shares with you. According to the Social Security Administration's own actuarial tables, the average male life expectancy from age 62 is approximately 81 years. The average female life expectancy from age 62 is approximately 84 years. For roughly half of male retirees, claiming at 62 is mathematically the right call based on average longevity alone. If your father passed in his 70s, your grandfather passed in his 60s, and your brothers are not living past their early 70s, the longevity math is overwhelmingly in favor of claiming early. Reason number 4, you are married, and your spouse earns significantly less than you over their working career. Social Security has a feature called the spousal benefit. If your spouse earned much less than you or stayed home with children or worked part-time for most of their career, their own Social Security benefit at full retirement age may be less than half of yours. Under federal law, your lower-earning spouse can claim a spousal benefit equal to 50% of your primary insurance amount at their full retirement age. But they can only claim that spousal benefit after you have claimed for your own benefit. If you postpone claiming until 70, your spouse cannot collect the spousal benefit until you do. For couples where one spouse earns significantly more than the other, claiming the higher earner at 62 unlocks several years of spousal benefits for the lower earning partner. Across the gap years between 62 and 70, those unlocked spousal payments can total $70,000 to $150,000, which often more than compensates for the slightly smaller checks the higher earning spouse takes by claiming early. Reason number 5, you have minor or disabled children still at home. This is one of the most overlooked Social Security rules in the entire system, and it is incredibly relevant for any retiree who had children later in life, who is raising a grandchild, or who has a disabled adult child who has been disabled since before age 22. When you claim Social Security, each minor child under age 18 or up to age 19, if still in high school, or any age if disabled before 22 is eligible to receive a dependent benefit equal to 50% of your primary insurance amount. The benefits are subject to a family maximum of approximately 150 to 180% of your primary insurance amount. But for a retiree with 2 minor children at home, that family maximum can mean an extra $24,000 to $30,000 per year in dependent benefits every single year until those children reach the cutoff age. If you postpone your Social Security claiming to 70, you forfeit every single year of those dependent benefits during the gap years, which can total well over $150,000 in lost benefits for a family. Reason number 6, you are divorced, your ex-spouse was a high earner, and you were married for at least 10 years. This is the reason almost half of divorced retirees are unaware of. Under federal law, if you were married for at least 10 years and you have not remarried, you are entitled to claim a divorced spouse Social Security benefit equal to 50% of your ex-spouse's primary insurance amount at their full retirement age. The claim does not affect your ex-spouse's benefit at all. It does not require their cooperation. It does not require them to know you are claiming. The Social Security Administration will simply pay you the divorced spouse benefit if you qualify. For divorced retirees whose ex-spouse earns significantly more than they did, the divorced spouse benefit is often greater than their own retirement benefit. And claiming for it at age 62 instead of waiting can mean tens of thousands of dollars in additional lifetime income that would otherwise be lost. If you are divorced, were married for 10 years or more, and have not remarried, you owe it to yourself to call the Social Security Administration and inquire whether you qualify. Reason number 7, the Social Security Trust Fund is projected to become insolvent in the year 2034. This is the reason every retiree under 65 needs to take seriously because the math is in the official Social Security Administration Trustees Report, and it is not speculation. According to the most recent Trustees Report, the Old Age and Survivors Insurance Trust Fund is projected to be depleted in 2034. If Congress does not act before then, federal law requires the Social Security Administration to pay only the amount of benefits that current payroll tax revenue can support, which the trustees project to be approximately 77% of scheduled benefits. In plain English, an automatic 23% across-the-board benefit reduction will take effect for everyone, regardless of whether you have already claimed or not. For a retiree currently planning to collect $30,000 per year in Social Security, that automatic reduction would mean a loss of approximately $6,900 per year for the rest of their life. There is no guarantee Congress will act in time to prevent the reduction. There is no guarantee the reduction will be partial rather than full. The bird in hand math in this scenario strongly favors collecting Social Security earlier rather than later, because every monthly check you collect before the trust fund deadline is a check you have already received in full. Now, before I wrap up, there is one bonus scenario that is the dark mirror of the 7 reasons I just walked through. And it is the trap that catches retirees who follow the standard wait until 70 advice without grasping the full picture. I call it the tax torpedo, and it is the single most expensive blunder retirees make in their 70s. Here's how the tax torpedo operates. If you wait until 70 to claim Social Security, your monthly check will be approximately 76% larger than your check would have been at 62. That sounds wonderful, but 3 years later, at age 73, your required minimum distributions begin on every traditional retirement account you own. The combination of a maximum delayed Social Security check plus required minimum distributions on a still sizable traditional individual retirement account balance pushes you into a high marginal tax bracket, makes up to 85% of your Social Security taxable, and triggers IRMAA Medicare premium surcharges that can cost you several thousand per year for the rest of your life. The retirees who get hit hardest by the tax torpedo are exactly the retirees who followed the standard advice, postponed Social Security to 70, and never converted traditional individual retirement account dollars to Roth during their low tax window. They walk into a tax cliff in their 70s that they cannot escape. Claiming at 62 and using the gap years for Roth conversion is the cleanest way to sidestep the tax torpedo entirely. This is why the 7 reasons matter. This is why the standard wisdom is wrong for so many retirees. And this is why I want every retiree watching this video to run the actual numbers, including the tax planning numbers, before locking in a decision to wait until 70. To help you do exactly that, my team and I have built a free resource called the 2026 Retiree Protection Checklist. It is a 42-page comprehensive guide that covers the Social Security claiming decision tree. We just walked through the 4 most important Roth conversion timing windows, the 9 Social Security and Medicare timing decisions retirees most commonly get wrong, the IRMAA A tier brackets and how to sidestep them, the 7 most commonly missed deductions for retirees, and the complete protocol for protecting your retirement accounts from federal reporting requirements and elder financial fraud. It is completely free. It is not a teaser. It is not a sales pitch. To get the checklist sent directly to you, go to goldenrights.kit.com.checklist. Enter your email, and the full checklist will be in your inbox within a few minutes. And while we are discussing taking control of your retirement finances, for any retiree who handles their own tax filing, I want you to look at TaxSlayer. TaxSlayer is the software I personally recommend to clients who are comfortable filing on their own. It is significantly less expensive than the major competitors you have heard of. It handles every scenario a retiree is going to face, including Social Security, income, pension distributions, required minimum distributions, capital gains, and the new 1099-K reporting requirements. And it is supported by a team of tax professionals you can actually reach on the phone if you get stuck. The link is in the description below this video, and using that link helps support this channel at no additional cost to you. Let me wrap up with the single most important point in this entire video. The decision of when to claim for Social Security is the single largest financial decision most retirees will ever make. It locks in a stream of income for the rest of your life. It interacts with your tax bracket, your Medicare premiums, your retirement account drawdown, and your spouse's benefits in ways that no online calculator and almost no general financial advisor will fully model for you. The standard advice to wait until 70 is right for some retirees. It is catastrophically wrong for many others, and the only way to know which category you are in is to run the actual tax-adjusted numbers, including the Roth conversion runway, the spousal benefit unlock, the family longevity break-even, and the trust fund insolvency math before you make the decision. Claiming at 62 is not a blunder. For the 7 scenarios I just walked through, it is the single most brilliant financial move a retiree can make. The retirees who lose the most money in retirement are not the ones who claim at 62. They are the ones who follow generic advice without doing the math. If this video was useful, please hit the like button right now, because that is the single most important signal that tells the YouTube algorithm to show this video to more retirees who are about to make the Social Security claiming decision and need to see the full picture before they commit. Subscribe if you have not already, because next week I am releasing a follow-up video on the 3 exact tax planning moves every retiree needs to make in the year before claiming for Social Security, regardless of whether they claim at 62 or 70. And if you know a friend, a sibling, a parent, or a neighbor who is between the ages of 60 and 70 and has not yet claimed for Social Security, send this video to them directly. The decision is too significant and too permanent to make based on a single advisor opinion or a single YouTube video. The 7 reasons need to be on the table. I will see you in the next Golden Rights.